What if the key to Bitcoin's next trillion-dollar move isn't some flashy new application or another country adopting it as legal tender?
Right, not a new tech breakthrough.
Exactly. What if the key is already sitting right there, quiet, predictable, and just absolutely massive?
Yeah.
Your own 401k.
It's an incredibly compelling question, and what we're about to unpack here is exactly why that seemingly mundane, highly conservative retirement account has become the single most contested battleground in financial policy today.
It's really amazing to think about.
It is. This is a story about regulatory fear, legislative maneuvering, and the staggering financial math that could literally change the trajectory of an entire asset class.
And we're not talking about small-scale stuff here. This isn't about individual speculation. We're talking about a silent war being waged over the sum of, what, $9.3 trillion?
$9.3 trillion. It's a number that's so big it's hard to even conceptualize.
Let that sink in. That's the amount of money locked away in American defined contribution retirement accounts. This pool of capital is so large that if even a tiny fraction of it, a single-digit percentage, gets exposure to digital assets,
the demand shock would be seismic. It would fundamentally reorient the global financial world. I mean, there's no other way to put it.
And this conflict, it's defined by two very heavily resourced and fiercely opposed sides.
That's right. On one side, you have the powerful gatekeepers.
The gatekeepers.
These are the established federal regulators, primarily the Department of Labor or the DOL, and they're working alongside these ultra-risk-averse employers, the plan fiduciary.
The people who actually run your 401k plan.
Exactly. And they enforce these arcane liability rules with an iron fist. Their mission, which is justified under long-standing law, has been to effectively freeze Bitcoin and other digital assets out of the traditional default retirement system.
Okay, so that's one side. And pitted against them, you have the Bitcoin Braves.
The Bitcoin Braves. This is an increasingly sophisticated and, I'd say, organized coalition. It includes frustrated retail investors who are just demanding choice.
People like you listening who just want to be able to choose.
Right. And they're joined by strategically aligned politicians in Congress who are fighting to dismantle what they passionately frame as paternalistic overreach.
Their goal is simple then, right? Just unlock what they call financial freedom. Give the average worker access to these high-growth alternative assets that historically only the wealthy could really touch.
Precisely. And for you, the listener, it's vital to understand this isn't some theoretical argument happening in a back room. This is a live, active, legislative and regulatory conflict.
It's happening right now.
And until recently, it was completely dominated by the gatekeepers. For years, we saw the deeply chilling impact of that 2022 Department of Labor warning. That's what our sources term the regulatory freeze.
Regulatory freeze. I like that term.
That guidance was a simple yet devastatingly effective tool. It scared virtually every employer in the country into total inaction.
But as you said, that narrative is shifting, and it seems to be accelerating pretty rapidly through the political years right now.
Very rapidly. We're tracking a massive coordinated offensive. It includes a new power configuration in Congress that's specifically targeting retirement legislation. And critically, we have this pivotal executive order EO 14330.
Right. And that, combined with the proposed Retirement Investment Choice Act, is aimed at dismantling the very structural barriers that have kept Bitcoin off the, the core menu.
The core menu of nearly every standard 401k plan in America. That's the prize.
So our mission in this deep dive is to unpack this specific critical moment in financial history. Where do we start?
We need to start at the absolute bedrock, the regulatory history, why the gatekeepers have so much power and how they use that power back in 2022.
Okay, so start with the problem.
Then we'll dissect the new legislative moves designed to counter that power. We'll clarify the revolutionary impact of that executive order. And finally, we'll analyze the absolutely staggering, eye-watering financial math behind the passive capital that is just waiting to flow into this asset class.
We're going straight to the sources today. The official documents, the legislative drafts, the analyst reports. We're focusing on the law, the politics, and the dollars. So stay with us as we dive into the deep dive. I'm Satosha.
And I'm Satoshi.
Okay,
Okay, let's unpack this and start with just the sheer scale of the conflict, because the size of the prize, that 9.3 trillion, it fundamentally explains the severity of the political battle we're seeing.
It really does. That's the capital that working Americans are relying on for their future. And the fact that it's defined contribution, meaning the employee is the one responsible for selecting the investments, that's crucial.
So despite the fact that we have these regulated, SEC-approved Bitcoin ETFs that have been trading successfully since 2024, if you look at the standard default core menus,
The list of 10 to 20 funds that your plan offers, right? That limited list. The allocation to digital assets is effectively zero.
it's a rounding error. It's nothing. That gap between what's available in the wider market and what's available in your 401k, that's where the value proposition and the conflict lies.
So to understand why that allocation is stuck at zero, we have to look at the historical legal foundation, the thing that gives the gatekeepers their power.
Which is the Employee Retirement Income Security Act of 1974, or ERISA.
ERISA. This is one of those dense pieces of legislation that has a huge impact, but most people have never heard of.
Exactly. It's the legal bedrock of the freeze. Its purpose is broad, but it boils down to one thing: protecting participants' funds. It sets minimum standards for how plans operate, for accounting, for funding.
And the gatekeepers who enforce it are the Department of Labor, the DOL, and specifically this group called the Employee Benefits Security Administration, EBOSA.
EDSA, right. The DOL holds the hammer because they're the ones who get to interpret and enforce the fiduciary duties laid out in ERISA.
And here's where it gets really important for the average person to understand. The definition of a fiduciary is critical here.
It's everything. Under ERISA Section 321, a fiduciary is anyone who exercises discretionary authority or control over the management of a plan or its assets.
So that's your employer. It's the retirement committee they set up. It could even be the record keepers themselves, like Fidelity or Vanguard.
All of them could potentially be considered fiduciaries, and the centerpiece of the DOL's control is the prudent man rule.
The prudent man rule, that sounds old.
It is. It's found primarily in ERISA Section 404, and this rule dictates that a fiduciary must act solely in the interest of the participants, and with the skill, prudence, and diligence under the circumstances then prevailing, that a prudent person acting in a like capacity and familiar with such matters would use.
Okay, that's a mouthful. Let's
Right.
break that down. So the standard isn't just a prudent man, it's a prudent expert.
Yes. Someone familiar with these matters, acting solely for the benefit of the retirees. And here's the key psychological lever, the part that creates all the fear.
The enforcement mechanism.
Right. If the DOL, or even just a plan participant, believes the fiduciary violated this duty by offering, say, a reckless investment option, the employer, the fiduciary, can be held personally liable and sued for the resulting losses.
Personally liable. That's terrifying if you're a CEO or on a benefits committee.
It's the single most important factor. That fear of personal liability is the core mechanism of the freeze. Fiduciaries managing billions of dollars for their employees are not primarily motivated by maximizing returns or offering cutting-edge assets.
No, they're motivated by not getting sued into oblivion.
They are overwhelmingly motivated by liability minimization. They are terrified of being the first to offer an asset like Bitcoin, which has a history of 80% drawdowns, and then facing catastrophic litigation if that volatility hits their participants' accounts. It's a career-ending risk for them.
But let's pause here and play devil's advocate. If the DOL is acting as a gatekeeper, isn't their mandate legitimate? They are protecting people who are often financially unsophisticated from extreme volatility, especially as they get closer to retirement.
That's the crucial question.
Is the paternalistic overreach argument made by the Braves just sour grapes from people who missed the crypto rally?
Well, the gatekeepers would strongly argue that they are simply executing their duty to protect vulnerable participants. They'd cite the volatility, the irreversible nature of blockchain transactions, the history of scams in the space.
All valid concerns, to be fair.
Absolutely. And they'd say that proves this asset does not meet the prudent expert standard. However, the Braves counter-argue that if an asset is regulated by the SEC, if it's widely held and recognized globally, then excluding it based only on volatility is equivalent to dictating financial outcomes. And that, they say, goes beyond mere prudence into something else.
So the conflict really comes to a head with the regulatory action of 2022. The clearest manifestation of this fear-based mechanism was this chilling effect created by, what was it called? Compliance Assistance Release Number 2022-01. It is issued by the DOL in March of 2022.
And this is the regulatory shot across the bow that locked the entire system down. Absolutely. The guidance was deliberately harsh and highly specific. It warned planned fiduciaries to exercise extreme care before even considering adding cryptocurrencies. But it went further than that.
How so?
The release explicitly stated that the DOL would initiate an investigative program targeting any plan that went ahead and offered broad exposure to crypto options.
So the key takeaway here is this wasn't an explicit ban. They never said, you can't do this.
No, it was a regulatory freeze. The DOL effectively told the market, if you offer this, we will come and audit you.
And they issued this threat well before regulated Bitcoin ETFs were even a thing. It was a preemptive strike against something they expected was coming.
It was. And this threat was more than sufficient to halt almost all movement. For the fiduciary, the employer, the choice was simple.
You could offer Bitcoin and risk an immediate, costly, protracted federal investigation and the potential for personal liability.
Or you simply offer the same old standard menu of funds and guarantee your own safety. The risk-benefit analysis overwhelmingly favored inaction. It wasn't even a choice.
And that freeze persisted, exactly as you said, even after the regulated Bitcoin ETFs were approved in 2024.
Right, which is so telling. The ETF structure solved a huge hurdle. The SEC had deemed the product itself safe and securitized, traded on regulated exchanges. But the ETF approval did not solve the fiduciary liability problem created by the DOL.
Because that 2022 guidance was still in effect. The fear of a DOL investigation was still there, so the ETFs remained off the core menu of major players like Vanguard and Fidelity. They just would not risk it, regardless of the product structure.
And that is the dam we are talking about. That is what the Braves are trying to break.
That's structural fear. The DOL's ability to use the threat of litigation to control the investment menu, that leads us directly to the counteroffensive. The other side of the battle, the Bitcoin Braves.
Exactly. So who are these Braves? They're more than just frustrated retail investors. They're using strategic political capital.
They see the 401k restrictions, enforced through that fiduciary fear, as fundamentally paternalistic overreach, something that actually harms the working class.
Right. Their argument is really based on a concept of financial opportunity. They're asking a simple question. If Bitcoin has demonstrably outperformed almost every traditional asset class over the last decade, and if its supply mechanism makes it a potential hedge against inflation, why should a third-party regulator, be it the government or your employer, be able to veto your choice to include a small allocation in your long-term savings?
And following the political shift that happened in the 2024 election cycle, this coalition launched a very targeted, very sophisticated legislative offensive. It's aimed squarely at unblocking all this retirement capital.
And we see evidence of this push in the documents, starting in late 2025. One key moment that highlights this new approach was the Hill-Atkins letter from September 2025.
Okay, who was that from and to?
This was led by the House Financial Services Committee Chairman, French Hill, a Republican from Arkansas, and it was addressed to the SEC Chair, Paul Atkins.
And the narrative they used in that letter was fascinating. It wasn't just about returns. They linked the restriction of 401k access to structural wealth inequality.
Yes. They claimed the SEC's use of the accredited investor definition was basically segregating the working class from high-yield alternative assets, not just crypto, but private equity too, in the most egregious way possible.
Can you explain that accredited investor rule for people who don't know?
Sure. It's basically a wealth test. To be an accredited investor, you have to have a certain income, typically over $200,000 a year, or a net worth of over $1 million, not including your house. Only then are you legally allowed to invest in certain private or high-risk ventures.
So their argument is that the wealthy meet these arbitrary thresholds, which give them unfettered access to all these alternatives that can generate huge returns.
Right. Meanwhile, the working class, who rely on their 401k for their primary savings, are confined to these traditional, often low-performing bond funds and cash equivalents, the very things that get crushed during inflationary periods.
So it reframes the whole debate. The lack of Bitcoin access isn't an issue of responsible caution anymore. It's an issue of systemic financial fairness.
Exactly. It reframes the gatekeepers' position. They aren't protecting the worker. They are protecting an archaic system that prevents the worker from building wealth at the same rate as the rich. And that is a very, very powerful political narrative. It resonates far beyond the typical crypto enthusiast base.
And that political pressure led directly to the legislative solution they've been pushing, the one aimed squarely at the DOL.
The Retirement Investment Choice Act.
Let's drill down on this bill. It's H.R. 50748. It was introduced in October 2025 by Representative Troy Downing. And its purpose sounds almost surgical.
It is. It seeks to legally strip the DOL of the ability to restrict an asset class based purely on its perceived investment merit. It's a direct shot at the authority of the gatekeepers.
So how does the language in the bill do that? The core problem, as we said, is the DOL threatening lawsuits based on volatility.
Right. So the bill tries to codify into law that a plan fiduciary your employer cannot be sued solely for the volatility of an asset, provided that the asset structure is regulated and meets certain criteria.
Okay, so they're drawing a really crucial distinction there. The Braves are essentially saying fiduciaries must still exercise prudence, but only regarding the process.
Exactly. They have to do their due diligence. They have to make sure the fund structure is legitimate. They have to confirm it's a regulated product, like an SEC-approved ETF. If they offer some fraudulent, unregistered product, they absolutely should be sued for malfeasance.
But, and this is the key legal shift, if they offer a regulated Bitcoin ETF, they can't be held liable just because the underlying price of Bitcoin dropped 50% in a given year.
That's the core of it. The bill aims to focus fiduciary duty on the integrity of the investment vehicle, not the short-term performance of the asset itself. If that bill passes, the DOL's primary weapon, the fear of volatility-based litigation, is completely neutralized. The regulatory dam fundamentally dissolves.
The Retirement Investment Choice Act is still working its way through Congress, but even before it could pass the Senate, the game changed fundamentally. There was a huge maneuver from the executive branch.
This is the true climax of the conflict. This is the critical turning point in the timeline, showing a real shift in presidential philosophy toward financial choice.
We have to introduce Executive Order 14330.
On August 7, 2025, President Trump signed Executive Order 14330, and its title says everything: democratizing access to alternative assets for 401k investors.
Wow, that title is a clear policy statement in itself. It aligns perfectly with the Bitcoin Brave narrative about fairness and choice.
It does. But the EO did far more than just send a signal. It fundamentally altered the liability landscape by aiming directly at the DOL, the primary gatekeeper.
Okay, so what did it actually do?
The EO contained two critical mandates aimed at dismantling that fear structure we've been talking about. First, it directed the DOL to formally stand down from its 2022 threats.
Wait, I'm looking at the timeline in our sources. It says the EO was signed in August, but the rescission of the 2022 warning was already executed by the DOL in May 2025. How does that work?
That's a great question, and it gets into the weeds of regulatory politics. The formal rescission in May 2025 was likely an internal DOL action, a formal withdrawal of the guidance, probably executed in anticipation of or in preparation for the upcoming presidential order.
So it was them getting ahead of the curve.
Exactly, signaling a return to what you could call regulatory neutrality. Then, the August EO comes along and formalizes that shift. It makes it an official, public, high-level policy directive of the entire administration. It gives the directive far more weight than just some internal DOL memo.
That makes perfect sense. So the May action removed the immediate threat of investigation, but the August EO solidified the long-term policy goal. So what was mandate number 2?
Mandate number 2 is the real structural overhaul. The executive order granted the DOL 180 days, which means the new guidance is due by February 2026 to draft rules that establish a safe harbor for employers.
Okay, safe harbor. Let's define that very clearly, because this sounds like the single most important mechanism for our listeners to grasp. It's not just protection from lawsuits.
No, it's more structured than that. Think of the safe harbor like a guaranteed recipe book provided by the federal government.
Recipe book.
Right now, employers fear the DOL will inspect their kitchen, their 401k plan, and sue them if the meal, the investment options, doesn't taste good, meaning it loses money. The DOL safe harbor changes that entire dynamic.
How?
The DOL is now mandated to create legal rules that, if followed precisely, guarantee the employer will be protected from litigation, even if the underlying investment option, like a volatile digital asset ETF, experiences losses.
So if the employer just follows the recipe,
they're legally shielded.
Well,
The OO requires the DOL to draft these rules specifically covering regulated alternative assets, and it explicitly defines digital assets as eligible, as long as they're offered as part of a diversified portfolio.
So, for example, the recipe might say, you can only offer SEC-approved ETFs. You must limit exposure to maybe 5% of the total plan, and you have to provide clear risk disclaimers if the employer does all that.
They're safe. They can no longer be sued into oblivion simply for offering the option. This safe harbor is the mechanism that finally bypasses the fiduciary fear. It allows employers to offer a regulated Bitcoin ETF from a firm like BlackRock or Fidelity without the crippling liability risk that has plagued them for years.
If that February 2026 guidance is strong and clear, it removes the legal uncertainty that has kept that $9.3 trillion dam intact.
And that's the whole game.
So the executive order succeeds and this safe harbor is established. We finally get to the ultimate goal. The entire battle is focused on one thing: moving Bitcoin from the high-friction, low-adoption window to the low-friction, high-adoption core menu.
Because the menu represents passive systemic flow. And that is what fundamentally changes the math.
The window is the current reality, right?
It is. It's the self-directed brokerage account, SDBA, or sometimes SDBW for window. Our sources rightly call it the backdoor or the secret menu.
And it is currently the only way most employees can get access to regulated assets, like Bitcoin ETFs, within their 401k. But the key statistic is adoption.
It's abysmal. Less than 3% of eligible employees ever actually use it, and that's entirely due to friction.
Let's use that cafeteria analogy you mentioned earlier because I think it illustrates the friction perfectly. Your 401k plan is the cafeteria.
Right. And the core menu is that limited list of items they serve every day. The standard mutual funds, the bond funds, the target date funds. It's easy, it's pre-approved, it requires zero thought. Pizza and burgers.
And the brokerage window is like a door in the back of the cafeteria that leads to a full financial supermarket. You can buy virtually any publicly traded security, including the new regulated Bitcoin ETFs.
But getting through that door is designed to be clunky, high effort, and frankly, intimidating.
Let's walk through the mechanics. Say I'm an employee, I heard about the Bitcoin ETF launch, and I want to buy some in my 401k. I log into my Fidelity portal. Where do we even start? I don't see Bitcoin listed on the main page.
Exactly. Step one is just locating the option. You have to actively search for these specific, often obscure terms. You're looking for Fidelity's brokerage link or Schwab's personal choice retirement account, the PCRA. The name itself signals this is not the main path.
Okay, so I finally find the link, hidden 3 layers deep in a menu. Step 2 is opening a subaccount, right? This isn't automatic. I have to manually enroll.
That's right. And this enrollment process is where the employer sets up their legal firewall. You have to create a separate subaccount linked to your main 401k. And critically, you have to read and sign this lengthy legal disclaimer.
And that disclaimer is the employer explicitly saying, we warned you.
Yeah.
I'm acknowledging that I'm venturing outside the safe, fiduciary vetted zone. And if I decide to put my money into something volatile, the liability is on me, the employee.
It is pure liability minimization, achieved by shifting the legal responsibility onto you. But even after you sign, the biggest friction point is step 3, funding the account.
Right. You can't just have it come out of your paycheck.
No. You cannot automate contributions directly from your paycheck into the brokerage window. You have to manually fund the window.
So first, my payroll contributions go into a regular core fund, like a money market fund. Then I have to log in and manually initiate a transfer of that cash from my core account into the brokerage window subaccount.
And you often have to wait several days for it to settle. That multi-step, manual, multi-day process is the absolute death knell for mass adoption. It requires active, repeated intent every time you want to invest.
Only after the cash finally settles in the subaccount can I move to step 4, buy the ticker. Then I can search for IBIT or FBTC and execute the trade.
It's 4 distinct, friction-heavy steps. It requires specialized knowledge, manual transfers, and acceptance of liability. It's designed specifically to filter out the 97% of passive investors.
And even after you climb over that whole dam, the employer still imposes guardrails, the catch, as you call it.
Yes, these are institutional restrictions designed to prevent people from going all in on alternative assets, even if they use the window.
The classic example being the 50% rule.
Precisely. Many plans will cap the total amount you can hold in your SDBW at 50% of your total portfolio value. They want to ensure at least half of your savings remains in their traditional low-volatility core funds. It's a risk management mechanism enforced even on the diehards.
And then there are the fees. The core menu funds are usually free, but many of these brokerage accounts charge annual maintenance fees. We saw examples of $50 a year, or they charge per trade fees. It's another small economic barrier to discourage the casual user.
And finally, there's the nanny filter. Some hypervigilant employers try to specifically block anything with crypto in the name, but here's the loophole the Braves are exploiting.
Well, this is interesting.
Because the Bitcoin ETFs are legally structured as equities or ETFs by the SEC, they often slip right through software filters that were designed to block actual crypto coins or other exotic products. They're legally distinct enough to bypass the restriction.
So the SDBW is basically a high-friction pressure release valve. It accommodates the sophisticated, motivated individual. But the core menu inclusion, that standard limited list of funds, that's the real prize.
Because that is what facilitates passive automatic capital flow.
Which brings us to the financial reality that justifies all this political and regulatory warfare. We need to quantify the sheer, staggering math of the passive trillions waiting behind that regulatory dam.
Let's revisit the number one more time. $9.3 trillion. That's the total 401k asset pool. And as we established, the amount of that capital currently in Bitcoin is negligible.
It's basically zero. We're dealing with an asset that is zero allocated in a multi-trillion-dollar pool.
So analysts are now modeling what happens immediately when that legal friction vanishes, when the Del-Well Safe Harbor is established or the Retirement Investment Choice Act passes. And Bitcoin ETFs can be offered as a standard default core menu option.
And they're modeling this based on standard portfolio diversification, right? Allocations between 1% and 5% for alternatives.
That's right. So let's start with the most conservative 1% allocation scenario. If only 1% of that $9.3 trillion pool flows into Bitcoin, that represents a capital inflow of $93 billion.
$93 billion.
To understand the magnitude of that number, we have to contextualize it. We have to compare it against the available market supply of Bitcoin.
Okay.
Our sources estimate the truly liquid supply of Bitcoin available on exchanges today, the coins that are actually available to be bought and sold by active traders, is roughly 2 million BTC.
Only 2 million. Out of a total supply of over 19 million.
Right, because the vast majority of Bitcoin isn't actively trading. It's held in long-term HODL wallets. It's in corporate treasuries like MicroStrategy. It's in institutional cold storage, or it's just plain lost because someone lost their keys. That 2 million figure represents the available market float that meets immediate demand.
And at late 2025 prices, that liquid supply is valued at what? Around $180 to $200 billion.
That's about right. So now do the math. A $93 billion inflow based on that conservative 1% allocation
Is equivalent to buying almost half of all liquid Bitcoin available on exchanges. Not 90%.
Let me recheck that. Yes, sorry, the estimate is closer to half. About 50% of all liquid Bitcoin. Still, that's not just a large investment. It's a catastrophic demand shock.
Half the available supply.
When you introduce a guaranteed, automated, recurring demand for an asset that has such limited available supply, you trigger exponential price multipliers. This money wouldn't just absorb half the current market float. It would radically reprice the entire asset class just to source the supply needed.
And that's just the conservative model. What happens if we move to a moderate 3% allocation?
If we get to 3%, which could be driven by aggressive fund managers who see Bitcoin as an attractive, uncorrelated risk asset, we're now looking at a capital inflow of $279 billion.
$279 billion.
And in the highly confident, aggressive 5% allocation scenario, which is not uncommon for alternative asset targets and other portfolios, that number jumps to $465 billion.
$465 billion. That single figure, just from 401k, exceeds the current market cap of almost every other digital asset in existence. The scale is just monumental.
But this money is different. It's different from the active capital we saw flowing into the spot ETFs back in 2024. This is the power of the default effect, and this is the critical insight into why core menu inclusion is the true prize.
Because most 401k money doesn't rely on active choice.
Not at all. It sits in what are called target date funds, TDFs. These funds are the set-it-and-forget-it default option, and they currently hold about $3.5 trillion of that total 401k money.
Explain how TDFs work and why they're the key engine for this passive flow.
TDFs operate on what's called a glide path. When you're young, say you're in a target date 2065 fund, you are heavily allocated to riskier assets like stocks. As you get closer to your target retirement date, the fund automatically glides toward a more conservative mix of bonds and cash.
And the crucial part is that HR departments automatically default new employees into the TDF that matches their age if they don't make an active choice themselves.
That's the default effect in action. Millions of Americans are already passively invested in funds that are automatically rebalancing on their behalf every quarter, and they rarely, if ever, check or change it.
So now imagine the scenario if the legal friction vanishes in 2026. The major TDF providers, BlackRock, Vanguard, Fidelity, who manage these $3.5 trillion pools, they'll review the new DOL safe harbor rules.
And if they're convinced of the liability protection, they could easily and responsibly decide to include a conservative 1% allocation of a regulated Bitcoin ETF inside their target date 2055 or 2060 funds.
And the result is passive, recurring flow.
Instantly. Tens of millions of Americans would start buying Bitcoin every 2 weeks, automatically via their recurring payroll contributions. They never had to click a button, they never read the lengthy SDVA disclaimer, and they might not even know they own it.
The default option changes, and the capital flows begin instantly and indefinitely, fueled by every single paycheck across the country.
Our analysis confirms that the unnecessary friction of the self-directed window acts as a dam, only letting the motivated few climb over. With core menu inclusion, that passive flow bypasses the dam entirely. It institutionalizes Bitcoin as a core component of American retirement savings.
And that is why this regulatory battle over a seemingly boring piece of retirement legislation is truly a battle for the trillions. Before we wrap up our analysis, we want to pause, as we always do, and just acknowledge the immense engagement we've seen for this show. When we started, it was just with a simple idea. Is there space for really deep analytical research outside the usual campus setting or the casual cafe talk?
And it's clear that you are all as fascinated by these deep dives into the complex confluence of technology, finance, and policy as we are. The appetite for rigorous, well-sourced analysis is huge, and we really appreciate you challenging us to dig deeper every week.
Absolutely. And speaking of deep dives, we've seen tremendous traction for the YouTube course we recently launched titled Bitcoin for Plebs. It's aimed at cutting through the noise and giving people a real foundational understanding of the asset class without all the jargon.
We're getting amazing feedback on that.
We are, and we will absolutely make sure that course is linked in the episode description below for anyone who wants to start their learning journey.
The ability to produce this level of content, both the deep dives you're hearing now and the high-quality video resources, it really depends entirely on community support. We're currently trying to unlock funding for a specific project, the Mosaic AI video editor,
which will allow us to start producing high-quality video versions of these deep dives, something a lot of you have been asking for.
And to make that happen, we need to hit 1,000 subscribers across all platforms, YouTube Music, Spotify, Apple Podcasts, wherever you listen.
So please, if you enjoy these discussions, if you value this kind of deep research, take a moment right now to subscribe. It really helps us continue producing what we hope is some of the most insightful content out there. Okay, let's bring all this together. What do we actually witness here? We've traced the history of this powerful, effective regulatory barrier, the dole's use of fiduciary liability fear under ERISA, which successfully created a dam holding back $9.3 trillion in capital.
And the core conflict, this battle between the gatekeepers and the Bitcoin braves, it's fundamentally a battle over default investment options. For years, the gatekeepers successfully used friction and the threat of litigation to keep Bitcoin out of the passive, automatic 401k infrastructure.
But that dam is now cracking, and it's cracking rapidly. The Executive Order 14330 mandated the formal rescission of that punitive 2022 guidance, and most importantly, it directed the DAO to establish a robust safe harbor.
A legal shield for employers, due by February 2026. This legal move is designed to fundamentally dismantle the fiduciary fear of litigation that created the regulatory freeze in the first place.
And if that safe harbor guidance provides strong enough liability protection, or if the accompanying Retirement Investment Choice Act passes,
the friction just vanishes. And the math is undeniable. A staggering $93 billion conservative inflow is just waiting, driven primarily by the passive automatic flow mechanisms inherent in those target date funds.
So what does this all mean for the bigger picture? Because the fight over the 401k goes so far beyond just Bitcoin's price, it feels like it's about the very definition of a prudent investment in the 21st century.
I think that's exactly right. For the last 50 years, prudence meant stability, low volatility, traditional asset classes. Now, the fundamental question being posed by the Braves and endorsed by the executive branch is this. Can a modern, forward-thinking financial system justify excluding a globally traded, digitally native asset from its most conservative long-term portfolios?
Especially when that asset is increasingly recognized institutionally as a store of value and an inflation hedge.
The dam is cracking, and the resulting guidance that's issued in the coming months, specifically that February 2026 DOL directive, is going to be absolutely pivotal. It has the potential to institutionalize Bitcoin, not as some speculative novelty, but as a core default component of American retirement savings for decades to come.
It would move from a niche market segment to a fundamental piece of the legacy financial architecture.
And this story is still unfolding in real time. The analysis we've provided is based on the most current legislative and regulatory documents available. But we want to hear from you. This is a community effort, and your practical experience really matters to the overall picture.
What are you seeing in your own 401k plan? Does your employer offer the brokerage window? And if so, did you climb over that dam to use it? If not, what is the level of fear and friction preventing your plan from offering the core menu option?
We invite you, our listeners, to share your analysis and your experiences in the comments or wherever you engage with this show. Are we being too optimistic about the safe harbor's potential to completely eliminate that fiduciary liability? Are we underestimating the resilience of the gatekeepers in finding new ways to impose friction? We genuinely want to know what you think.
As always, keep searching, keep the quest on.